Hey guys, welcome back to another exclusive podcast from IronFX. At IronFX, we're dedicated to bringing you the absolute best trading education to help you take your trading to the next level. In today's podcast, we're going to talk about what are the top 3 biggest mistakes to avoid in trading. Right, so this happens a lot, right? I've seen a lot of mistakes that traders make over the years, over almost a decade of trading. But these are, I feel, my top 3. Right, the most common one is revenge trading. Right, revenge trading. The definition of revenge trading is when a trader, for example, you make a loss, right? You get upset that you make a loss, right? Then you double up your position, or you get into bigger positions chasing your losses. Right, this is usually driven by a very emotional state, right? Meaning that you're emotionally charged up, you're upset that the market has so to speak wrong you, right? And because of that, you start putting bigger positions and hoping to make your loss back. Now, one good way to avoid this, right, is to take it from the from the very objective perspective, right? That you're always going to make losses, right? It's not personal, right? And the key thing I always tell myself is that the market, right, trading is not like the world of academia. Right, the world of academia, right, means that the harder you study, the better you do. Right, if you study, the more if you have an exam that is coming up, right, if you study, right, you will do well. If you don't study, you won't do well. Right, so it's it's very correlated, right? There's a positive correlation there, right? The knowledge equals how right you can be. The more knowledge you have, the more right you will be, the more correct you will be. But the market is not like this, right? Surely the market will reward you for learning how to trade it, right? For learning about the different strategies and stuff. But it's not so crystal clear like right and wrong, right? For exam, you have a right answer, you have a wrong answer. But for trading, it's not that case, right? You can have all the correct things that line up. You can have you can have like all the check boxes in your trading strategy says that it's going to be correct, but when you take the trade, it goes against you, right? And usually in that kind of case, you get upset because in your mind you're like, this can't be happening, right? This can't possibly be right. Now I am supposed to be correct. The market is supposed to be wrong because I applied my strategy exactly the way that I think it would work. Right, but as long as you take the perspective that that's not always the case, right, you will take each loss with more what I call it, more gracefulness, right? You would think that, all right, or rather more humility. You'd be like, all right, I thought it'd be correct. There was a high chance that I'll be correct, but I am wrong, so it is fine, right? And you won't go into revenge trading mode because right? You know for a fact that the market doesn't care if you think you're right. Right, the market, the market will not reward you for applying every single checkbox in your trading strategy, thinking that you're going to be right but end up wrong. All right, so always remember that, right? You need to apply humility in your trading. Okay, next thing, right? The next big mistake I always see is having a daily target or weekly target, monthly target, right? So some people are always saying, I have a target to make 100 pips a day, or I have a target to make 1% a day, 2% a day, right? Nothing wrong. Actually, I think it's not that there's nothing wrong. There's everything wrong with having a daily target, right? Imagine the markets are closed on a weekend. Will you suddenly say that you have a daily target? I want to make 1% on a Saturday. No, right? Because you know that the markets are closed. But why would you have a daily target if the market is perhaps not moving in your favor? If the market is like close to Christmas, or it's in a period where there's low volatility, would you still insist on having that target? Would you still say, I want a daily target? I want to make 1% today. The markets are not moving at all, right? Why do you still want to make that 1%? Why do you want to try to squeeze up that 1%? And it's because you have that daily target. You tend to you start looking for trading opportunities. They are not there, right? And then the next thing you know, you start looking at the lower time frames, right? You start throwing out additional indicators. You start looking at, trying to find a way, to look out for this trading trend, to look out for this trade just to hit your 1%. And that's the danger, right? You should not have a daily target. You just trade what the market gives you. If there's nothing, then don't try to squeeze it out. If there's something, then trade it, right? It can't be a case where, you hit your target for the day and the market is just giving you so many more trading opportunities. Would you just stop there and say, you know what, maybe I won't trade? Right? That's not the case. Trade when the market gives you something to trade, and don't trade when the market has nothing to trade. Right? So second biggest mistake is having a daily and weekly target. Right? Don't have any of those. Trade basically what the market gives you. Right? And of course, actually part two, having a daily and weekly target is one of the major causes of having of going down revenge trading, because people start compromising on their entries. Right? Maybe they had a pretty successful day so far, but because they're trying to hit their targets, right, they start compromising on the entries, and they get losses, they get upset, they go into a revenge trading cycle, they blow their account, right? So you can see how all of these are linked, right? And the last big mistake I noticed traders making is that they like to focus on one instrument, right? They say, I'm going to be a euro dollar trader, right? I'm going to know euro dollar inside out, and I'm going to trade it. But the mistake there is you're running with like blinds, right? It's like you're having a tunnel vision if you do that, because euro dollar is affected by the dollar index. Euro dollar is affected by the dollar franc, right? Euro dollar has a correlation with pound dollar, and euro dollar is affected by so many different things, right? So if you want to trade one instrument, I would say trade one. You need to broaden minimally to your analysis to the correlated instruments. Right, so if you're going to trade euro dollar, you need to look at you need to monitor dollar index, you need to monitor dollar franc, you need to monitor maybe gold, right, as a risk haven, right? You need to monitor these different things, and maybe even pound dollar and dollar yen, right? Because they all move in tandem. They give hints to each other, like, hey, dollar franc has started reversing, that means euro dollar will bounce because they are negatively correlated. Right, so that's an important thing to take note of, right? If you don't just focus on one instrument, because that's like having tunnel vision when you're trading, but instead look at all the different correlated instruments and you trade them. You don't need to look at the whole market, right? But you just need to look at the correlated instruments, right? And that helps you trade the market with a lot more accuracy. Okay. Anyway, guys, that's it for me for today's podcast. On the top 3 biggest mistakes to avoid in trading. Do remember to subscribe to our podcast. As here at IronFX, we're dedicated to bringing you the very best trading education to help you take your trading to the next level. Until then, stay safe, trade safe, and peace out, guys.